A Canadian couple sold their rental property for a $275,000 profit and owed $65,000 in tax. They had no idea it would be that much. Meanwhile, a business owner sold for $1.2 million in gains and paid zero. Same country, same tax system, completely different outcome. I'm Brandon from LifeMoney. Today I'm showing you exactly how capital gains tax works in Canada, 3 real scenarios at different wealth levels, and the exemptions that could save you everything. Let's get into it.
In 2024, the government announced they were raising the capital gains inclusion rate from 50% to 66.7%. Investors panicked. Business owners panicked. People selling cottages panicked. Then, on March 21, 2025, Prime Minister Carney canceled the whole thing, and now everyone's confused. Is capital gains tax going up, going down? What are the actual rules? Here's what I'll tell you. The rate hike is dead, but capital gains tax in Canada is very much alive. And if you've sold or you're planning to sell an investment, a rental property, a cottage, or a business, you need to know exactly how this works, because the wrong move here can cost you tens of thousands of dollars. Today I'm giving you the complete up-to-date breakdown. The formula, the real 2026 numbers, 3 real examples at different wealth levels, and the key exemptions that could save you everything. Let's make sure we're on the same page before anything else. A capital gain happens when you sell something for more than you paid for it. That something could be stocks, ETFs, a rental property, a cottage, cryptocurrency, or a business. The amount you paid, plus any improvements or buying costs, is called your adjusted cost base, or ACB. So, if you bought a rental property for $350,000 in 2014, added $25,000 in upgrades over the years, and sold it for $650,000 in 2026, your capital gain is $275,000. Now here's the part that makes Canada's capital gains tax different from how income tax works. Canada does not tax all of your capital gain. You only pay tax on 50% of it. This is called the inclusion rate, and it's one of the most significant tax advantages available to Canadian investors. Now, why does this matter so much? Because compare that to, say, earning $275,000 in employment income, where every single dollar gets taxed at your marginal rate. Capital gains are treated far more favorably. And yes, in case you saw the headlines, the proposed hike to 66.7% was officially canceled. As of March 21, 2025, the CRA has confirmed it is administering the 50% inclusion rate going forward. That's the law as it stands today. So, on that $275,000 capital gain, only $137,500 gets added to your taxable income. The other $137,500 completely sheltered. This is the 50% inclusion rate doing its job. It cuts your exposure in half before you even start calculating what you owe. And yes, in case you saw the headlines, the proposed hike to 66.7% was officially canceled. As of March 21, 2025, the CRA has confirmed it is administering the 50% inclusion rate going forward. That's the law as it stands today. So what does this actually cost you? Your capital gains tax depends on your province and your total income for the year, because the taxable portion of your gain gets stacked on top of everything else you earned. Let's use Ontario as our example, since it's Canada's most populous province. In Ontario in 2026, here's how capital gains tax rates break down. And remember, these are percentages of your full capital gain, already factoring in the 50% inclusion. If your total income is under $53,891, you're paying about 9.5% on capital gains, $53,891 to $94,907, around 14.8%, $94,907 to $150,000, roughly 16 to 22%, $150,000 to $220,000, around 22 to 24%. Over $220,000, up to about 27%. To put that in perspective, someone in the top tax bracket in Ontario pays about 53% of their employment income in tax. But on capital gains, only about 27%. The inclusion rate cuts your effective rate nearly in half. Let's make this concrete with 3 real scenarios. You're 32 years old. You earn $65,000 at your job. In 2026, you sell some ETFs and walk away with a $20,000 capital gain. Step 1. The inclusion rate cuts that in half. $10,000 gets added to your taxable income. Your total income is now $75,000. In Ontario, at that level, your marginal rate is roughly 31 to 33%. Tax on that $10,000. Around $3,100 to $3,300. On a $20,000 gain, you owe roughly $3,200 in tax. That's an effective rate of about 16% on the full gain. Not bad, especially compared to what you'd pay if that $20,000 was a salary bonus. Now let's look at the classic Canadian scenario that affects a lot of people right now. You bought a rental property in 2014 for $350,000. Over the years, you put $25,000 into renovations. Your ACB is $375,000. You sell in 2026 for $650,000. Capital gain, $275,000. Inclusion rate, 50%. Taxable capital gain, $137,500. Now here's where it gets important. That $137,500 gets added to all your other income for the year. Say you also earned $80,000 from your job. Your total income is now $217,500. That puts you deep into a high bracket. Your marginal rate on the capital gains portion, roughly 48 to 50% in Ontario at that income level. Tax on the $137,500 capital gain income, approximately $65,000 to $69,000. Effective rate on the full $275,000 gain, roughly 24%. So you pocketed $275,000 in gains and owe about $65,000 to $69,000 in tax. That's meaningful. If you're a rental property owner planning a sale in 2026, you want to plan around this number, not discover it at tax time. Here's where things get really interesting for small business owners. You've built a company over 20 years. You sell your qualifying small business shares in 2026 for a gain of $1.2 million. Normally, that would generate a massive tax bill. But here's the thing. Canada has something called the Lifetime Capital Gains Exemption, the LCGE. In 2026, the LCGE is $1,250,000 for qualifying small business shares and farming and fishing property. This was actually an increase the government kept, even when they canceled the inclusion rate hike. It went up from about $1 million previously. What does this mean? The first $1,250,000 of capital gains on the sale of qualifying shares is completely exempt from tax. So on a $1.2 million gain, your tax bill is zero. That's a legitimate, legal, intentionally built-in tax shelter for Canadian entrepreneurs. It's one of the best tools in the tax code. To qualify, your shares must be in a Canadian-controlled private corporation and meet certain asset tests. A tax accountant can walk you through the checklist, but if you're even remotely close to selling a business, this is a number worth knowing. Okay, one more major exemption that affects most Canadians. If you sell the home you actually live in, your principal residence, you pay zero capital gains tax. Doesn't matter if the profit is $200,000 or $1 million. If it was your principal home the entire time you owned it, the principal residence exemption shields the whole gain. Canada does not tax Canadians on the growth in their primary home. It's one of the biggest tax-free windfalls available. The catch? Only one property per family unit can be designated as a principal residence per year. So if you own a home and a cottage, one of them is exposed to capital gains tax. And there's an important note. When you sell, you're required to report the sale to the CRA on your tax return, even if you owe nothing. This has been required since 2016. A lot of people skip this and get CRA letters. One more thing I have to flag, because this catches a lot of people. If you bought a property, any property, and sold it within 365 days, the CRA may classify that gain as business income, not a capital gain. Why does that matter? Business income is taxed at 100% inclusion. No 50% discount, no principal residence exemption. The full gain gets added to your income and taxed at your full marginal rate. This is the flipped property rule, and it has real teeth. There are exceptions: job relocation, divorce, death, severe illness. But speculative quick flips get hit hard. If you're an investor thinking about a short-term property play, build this into your math. Let's bring this together. Capital gains tax in Canada in 2026. 1. The inclusion rate stayed at 50%. The proposed hike to 66.7% was cancelled. You only pay tax on half your capital gain. 2. Your actual tax rate depends on your province and total income. In Ontario, effective capital gains rates run from about 10% to 27% of your full gain, roughly half of what you'd pay on employment income. 3. The lifetime capital gains exemption is now $1,250,000 for qualifying small business and farm shares. If you're selling a business, this could mean zero tax. 4. Principal residence exemption means selling your actual home is tax-free, but you still have to report it to the CRA. 5. Owned a property for less than a year? Flipped property rules may apply. That's business income, not capital gains. For more Canadian money breakdowns, tax strategies, investing basics, retirement planning, head to lifemoney.ca. The link is in the description. And for free Canadian financial calculators, no sign-up, no email, check out calculatorsmax.com. Everything from RRSP withdrawal to mortgage affordability to capital gains estimates. And if this video helped you, subscribe. We put out content like this every week. Practical, no-fluff Canadian finance that actually applies to your life. Our RRSP withdrawal tax video is queued up next. It's essential if you're thinking about pulling from your RRSP. A lot of the same principles apply, and the surprises are even bigger. See you there.